This is Nightly Business Report with Bill Griffith and Sue Herrera.
Payday. Amazon, one of the country's biggest employers, is raising the minimum wage for its workers, and it's encouraging others to do the same.
Blue chip record, the Dow hits an all-time high as investors cheer the strong economy.
Mortgage fraud, rising home prices are making it harder to afford a house. So some buyers have decided to fudge the numbers. Those stories and more tonight on Nightly Business Report for Tuesday, October 2nd.
And we do bid you good evening, everybody. Now, ordinarily, the Dow closing at an all-time high would be our top story. But that's not the case today. We will have more on Wall Street's record-breaking day in just a moment. But we begin tonight with one thing that has been helping to fuel the stock market higher. That is the job market, which is coming into sharp focus this week. Tomorrow, we get ADP's private payroll report. Thursday, the weekly jobless claims. And Friday, the government's monthly employment numbers will be released. But today, the job story was about Amazon. The company, which is one of the country's biggest private employers, raised the minimum wage for its workers to $15 an hour. That's more than double the federal minimum wage, and it includes all of its full-time, part-time, temporary, and seasonal employees here in the U.S. It is a change that could have a wide-reaching economic impact, especially when you consider that Amazon has added more American jobs in the past decade than any other company. And its yet to be announced second headquarters is expected to employ an additional 50,000 people. As Courtney Reagan reports now, Amazon's wage increase could inspire other companies to follow.
A big move for a big company just in time for the holidays.
Amazon minimum wage at $15 an hour.
Amazon is increasing its minimum wage in the U.S. to $15 an hour from an average $11 an hour currently. 250,000 part-time, full-time, and seasonal workers will benefit from the higher pay starting November 1st. At the same time, Amazon is phasing out its restricted stock program, saying employees prefer, quote, predictability and immediacy of cash. The company says the net effect is significantly more total compensation, but hasn't detailed how much it'll cost.
We think it's a modest impact. We don't think it's going to have a material impact on the bottom line. Remember, Amazon has so many initiatives, so we think this is a great move.
Senator Bernie Sanders has been a very vocal critic of Amazon, pointing to the pay disparity between hourly employees and founder and CEO Jeff Bezos, who's now the richest person in the world. Sanders had said Amazon doesn't pay employees enough, pointing to those on food stamps and Medicaid.
Well, we stepped back, we listened to our critics, we thought long and hard about what we wanted to do. We really evaluated our approach to compensation and decided we wanted to lead. We wanted to come out, we wanted to do this now.
The senator now giving Bezos and Amazon credit for the pay increase.
Mr. Bezos and Amazon are now leading the way, but there is absolutely now no reason why other profitable corporations like Walmart, like the fast food industry, like retail in general, and other employees, no reason now why they also should not be paying their employees at least $15 an hour.
Bezos responding in a tweet, "Thank you," at Senator Sanders. "We're excited about this and hope others will join in."
Amazon's cheering this move. Other retailers are crying right now over this.
3 years ago, Walmart made a multi-billion-dollar investment to increase workers' pay, now at $11 an hour. Target is at $12 with a goal of $15 by the year 2020.
If you want to succeed in the future, you have to match this. Otherwise, you end up with a demotivated workforce, or all the good ones leave and go somewhere where they make more money.
In a tight labor market, a high wage is the best recruiting tool, just in time to fill Amazon's 100,000 seasonal jobs. For Nightly Business Report, I'm Courtney Reagan.
Even with the tight labor market, the chair of the Federal Reserve does not expect inflation to rise sharply. In a speech today on the economy, Jerome Powell called the broader pickup in wages a welcome development and said he is not concerned about overheating.
What is more likely, in my view, is that many factors, including better conduct of monetary policy over the last few decades, have greatly reduced but not eliminated the effects that tight labor markets have on inflation.
Chairman Powell said he expects to stick with the central bank's current path of gradual interest rate hikes.
Michael Ferroli joins us right now to talk more about the impact of Amazon's move here. He's chief U.S. economist at J.P. Morgan. Michael, good to see you again. Welcome back.
Thank you.
So I guess this is what a tight labor market does. Wages start to go up, don't they?
Exactly, and I think Amazon's move, rather than having a big direct effect on the economy, is more reflective of an economy that is already starting to operate at or beyond full employment. So I think the fact that we have an unemployment rate below 4% has generated or helped to contribute to Amazon's move, and I think it has been a factor in some of the other large retailers that have also announced a big move.
What about the fact that, Senator Sanders, who was featured in Courtney's piece, is calling on all the major retailers to raise wages? Today alone, we had thousands of employees of McDonald's in Detroit rallying, asking for $15 an hour. At what point does that start to trickle down, if at all, to the economy?
Right. So, you can't totally discount that there may be some PR benefit or some social responsibility aspect here. But it's interesting that all these announcements are coming at a time when the labor market is very tight and not 5 years ago. So I think it is, it's reflective of the fact, as I said, that we have a very tight labor market. I think it is starting to gradually show up in the aggregate numbers. We're starting to see average hourly earnings creep higher. We'll get another look at that this Friday for the September numbers. But it is starting to gradually show up in average Americans' paychecks, and we think, given the current trends, that will probably continue on into next year.
So you think other companies will be forced to follow Amazon's lead here? Is that the idea?
I think they will, not necessarily because Amazon is bidding away so many workers. I mean, even Amazon, a huge company like they are, employing 250,000 people. In an economy that employs 150 million, that's about 0.2% of overall employment. So I think instead of Amazon being a direct impact on itself, the fact that they're doing this is probably reflective of a broader economic environment that other companies are also feeling, and they probably will feel the need to raise wages to retain workers. We're actually interestingly seeing the number of workers quitting their jobs recently near all-time highs, and I think that is a reflection of workers voting with their feet, that if they don't get a raise, they can go somewhere else and try their luck elsewhere. So I think you are going to see other companies follow, not because necessarily they're being exhorted by Jeff Bezos to do so, but because it's in their own best interest to do so.
Mr. Powell said that he does not see it as inflationary. At what point might it become inflationary? Would we have to see yet another jump in hourly wages?
I think so. We're still, we're coming off a period where wages have been running quite a bit below what we thought they should over the past couple of years. So that means there is some scope here for wages to run a little hot. Maybe that pressures corporate margins a little bit, but profit margins are starting at a high point. So that process can run for perhaps several quarters, if not a few years, before you necessarily see inflation get really out of hand. So I think there is some scope for wages to continue to grind higher without necessarily inflation moving up. Now, obviously, it's Powell's job to watch the inflation numbers very carefully for any hint that that's happening. I think so far he can probably rest easy that we're probably still, several months or quarters away from that being a really big concern.
Michael Ferroli with J.P. Morgan again. Thanks for joining us tonight.
Thank you.
As we mentioned earlier in the broadcast, the Dow closed at an all-time high, rallying for a second straight day to start the fourth quarter. But the other indexes moved in the opposite direction. The Dow Jones Industrial Average rose 122 points to 26,773. The Nasdaq fell 37, and the S&P 500 was down 1 point. Bob Pisani takes a look at what drove the blue chips to new highs.
Industrials drove the bulk of the gains in the blue chip index, with trade-related names like Boeing, Caterpillar, United Technologies leading the charge and having an outsized impact on the Dow versus the other major averages. In fact, Boeing hit a new all-time high today. Now, tech also helped fuel the rally, with Apple and Intel and other chip stocks bouncing back despite some worries over memory pricing and demand. Now, on the flip side, there were two key groups that were left out of today's rally: the bank stocks, again, and retail names. The banks have been lagging because loan growth has been lackluster, the yield curve has been flat, and because they've had to pay more interest to their depositors. As for the retail weakness today, let's call it the Amazon effect again. Big names like Ascena, Abercrombie & Fitch, Gap, and smaller retailers like Buckle were all down 4, 5, 6% after Amazon's decision to raise its minimum wage to $15. Some are concerned that this will add another layer of stress for retailers, most of whom pay far below $15 as a minimum wage. Retail margins have already been pressured by higher input and transportation costs. That's a big issue. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, rising confidence in the economy is also helping auto sales remain relatively strong. And the latest numbers for September that were released today show Americans are willing to hand over a near record amount of money for a new car or a truck. Phil LeBeau has the details.
With prices at the pump relatively stable and the economy roaring, auto dealers continue to see brisk business. Last month, Fiat Chrysler outpaced Toyota, Ford, and Honda, who all sold fewer vehicles than a year ago. That's because Hurricane Harvey brought massive flooding along the Texas and Louisiana coasts, leading to a surge in replacement sales in September of last year. For all of 2018, sales are on pace to top 17 million vehicles for a fourth straight year. Not only are Americans buying vehicles at a healthy clip, they're paying more. The average price paid now tops $35,700, largely because pickups and SUVs, which come with higher sticker prices, remain red hot. And that's good news for the bottom line of automakers. Still, auto stocks are stuck in neutral, with some actually pulling back. Ford is down 26% this year, despite the fact its F-Series pickup is enjoying record sales. Proof investors are looking for more than strong demand in the showroom. Phil LeBeau, Nightly Business Report, Chicago.
Meanwhile, Tesla met its production and delivery goals when it comes to its Model 3 electric sedan. The company said today that it delivered more than 55,800 vehicles to customers in the third quarter. That is 3 times more than they delivered the previous quarter. But the stock fell after Tesla warned of problems selling cars in China because of the new tariffs.
It's time to take a look at some of today's upgrades and downgrades. General Electric was upgraded to outperform from sector perform at RBC Capital. The analyst cites the successful track record of its newly installed CEO, who reported on the management change yesterday. The price target is $15. Separately, though, S&P downgraded GE's credit rating, and Moody's put it on review for a possible downgrade. But shares rose nonetheless to $12.32. Chevron was added to the conviction buy list over at Goldman Sachs. The analyst says risks to the stock have been overstated. The price target is $142. The stock rose a fraction to $124.74.
And that same analyst at Goldman Sachs downgraded ConocoPhillips to neutral from buy. The firm cited the stock's valuation. Price target now $81. The stock fell 2% to $78.28. Weight Watchers, which is now simply called WW, was added to JP Morgan's focus list. The analyst says that the stock's recent pullback makes it more attractive. Price target now $120. That stock rose nearly 1% to $73.35.
Still ahead, Pepsi's beverage sales return to growth just as the company's CEO exits. The FDA conducted a surprise inspection of Juul's headquarters last week. The agency is looking for additional information about the company's sales and marketing practices. Inspectors collected more than 1,000 pages of documents. The surprise visit was part of the FDA's crackdown on e-cigarette companies.
More people are drinking Pepsi's teas and Gatorade and colas these days. The company said today its beverage business returned to growth in the most recent quarter, helping Pepsi report a rise in profits on CEO Indra Nooyi's last day in the corner office. But higher costs are still a concern for investors. The stock fell in trading today. Sarah Eisen has more on Pepsi's latest quarter.
Indra Nooyi ending her 12-year tenure as CEO on a high note. PepsiCo posting a strong 4.9% organic revenue growth, which is the metric the industry uses to show how the underlying business is doing. It was double-digit increases internationally, growing Frito-Lay snacks business, and a turnaround in beverages, all contributing to the growth. However, the strong dollar did put a dent in the profit outlook.
From the standpoint of the overall financials of the company, the first half of the year, the dollar was actually a tailwind to our results. It flipped to a headwind in Q3, and it'll be a slightly more substantial headwind, we believe, in Q4.
On New Year's last day, she told analysts and investors, "I have been blessed to lead such a great company." During her leadership at Pepsi, she steered the snacks and drinks company early toward what she called better-for-you offerings like Quaker Oats, Bare Fruit snacks, bubbly sparkling water, and recently doubling down on sparkling water by acquiring SodaStream. She also successfully managed to fight off an activist investor who pushed to split the business into snacks and beverage companies. However, when Ramon LaGuarta, a 22-year-old veteran of the company, does take over tomorrow, there are still plenty of questions. Pepsi's stock has underperformed Coca-Cola this year, and one reason is that Coke has moved to unload its bottlers, making a leaner, more focused company. It's also been more willing to think outside the box. Coca-Cola recently confirming it is exploring development of CBD beverages made from cannabis. Newey's exit also marks a shrinking group of female CEOs, less than 25 of them right now within the S&P 500, less than 5% of the overall index. For Nightly Business Report, I'm Sarah Eisen.
The FDA grants breakthrough therapy designation to Clovis Oncology's experimental treatment. That is where we begin tonight's market focus. The cancer drug maker said the designation for its prostate cancer therapy was awarded based on initial data from Clovis's ongoing study of the drug. The new status is intended to speed up the approval process for the treatment. Shares of Clovis Oncology rose more than 7% to $31.39. Payroll processor Paychex said higher revenue in its services segments helped total sales edge past expectations. The company also topped earnings estimates. Shares rose more than 1% to $74.78. Delta said that it took a $30 million hit from Hurricane Florence and is facing rising fuel costs. There is also a chance that the airline's profits for the quarter will miss expectations. Separately, its rival, United Continental, also gave a disappointing earnings outlook for the year. Shares of Delta were off 3% to $54.69. Meanwhile, United Continental shares fell 1% to $86.71.
After the bell, Reuters reported that mattress firm could file for bankruptcy as soon as this week. The report added that the nation's largest mattress retailer is looking to terminate costly store leases due to its poor financial performance. And that news sent shares of rival mattress retailer Tempur Sealy initially higher in after-hours trading tonight. They were off nearly 2% to $48.38 during their regular session. Mattress Firm's parent company, by the way, does not trade here in the United States. Also out after the bell tonight, JCPenney said it has appointed Jill Soltau as its new chief executive. She was previously CEO of Joann's Stores, the fabric and craft supplies retailer. Investors were pleased, obviously. They sent initially shares higher in after hours, as you can see there. But during the regular session, shares of JCPenney finished down 8% to $1.56.
Chinese buyers are backing away from doing deals in the U.S., largely due to trade tensions and heightened regulatory restrictions. According to Deal Logic, the number of deals are a fraction of what they were just a few years ago. Leslie Picker is with us now to discuss the pros and the cons of fewer cross-border mergers. Good to see you as always, Leslie.
Hi, good to see you, Sue.
So how does Chinese deal-making compare today with that of just a few years ago, before the trade rhetoric was so much in focus?
So when you look back to 2016, Chinese companies were buying about $31 billion worth of assets here in the U.S. When you look at that same period, the first 9 months of the year of 2018, that number is about a fifth. And compared to last year, the number is half. So we've seen a dramatic decrease in inbound M&A activity coming from China.
So what do the talks between Chinese and American companies look like now, Leslie?
So according to sources I've spoken with, they've pretty much grinded to a halt any discussions that were taking place between Chinese companies and American companies have basically gone nowhere because everyone is very trigger shy when it comes to actually signing deals. They're worried that the trade tensions could spill over and that these massive multi-billion-dollar deals that they're discussing could become a problem. And it's very, very, very challenging for companies once they have signed deals to then face issues on the regulatory front, face issues from the trade front, because it causes a lot of missed opportunities and it requires them to therefore backtrack. And as deals are signed, companies kind of put other projects on hold.
Right.
So those opportunity costs become problematic down the road if a deal ultimately doesn't come together in the end.
You mentioned regulation. How much do you think regulators in either China or the U.S. have contributed to where we find ourselves right now?
We're seeing both sides really clamp down on moving assets abroad. On the U.S., there's something called the Committee on Foreign Investment in the United States, or CFIUS. And their role, this agency, which is comprised of members of the Treasury and National Security, members of the administration, their role is to really look at inbound foreign direct investment and determine whether it could be a national security concern. Their powers have been expanded as of mid-August, and therefore it's very uncertain for Chinese companies or companies elsewhere to really pursue acquisitions here because they're not quite sure what those rules look like or what they'll look like in practice. And on the Chinese side, they have been clamping down on these big conglomerates that have taken on a lot of debt in recent years. And they're saying, you can't actually take on more debt to fund acquisitions in the U.S. or elsewhere.
All right, Leslie, thank you so much. Leslie Picker at the New York Stock Exchange tonight.
Coming up, a new risk developing in the mortgage market: fraud. 10 years after the subprime mortgage crisis, there is a new risk developing in the mortgage business, that is fraud, and maybe not the kind you're thinking about. Diana Olick has more.
As home values rise and more people want to be homeowners, it's inevitable. More will lie and cheat to get a mortgage. Mortgage fraud risk jumped over 12% annually in the end of the second quarter, according to CoreLogic. They gauge risk by looking at instances of fraud in identity, occupancy, and income, among other things. The biggest jump, 22%, was in misrepresenting income. Lenders are pretty strict now about how much debt you can carry in relation to income, so people are juicing the numbers. Also, more investors in the market for renting or flipping means more people claiming they'll occupy the property when in fact they won't.
Most people will want to say that they're living in a property because their terms of their loan are going to be better than if they're buying it as an investment.
Matt Lieberman of Apex Home Loans says this is the most common type of fraud he sees, but all fraud means more risk for his business when he sells to banks or investors.
If for some reason they see something that we missed, that we should have caught, they could then force us to buy back the loan, meaning that they won't actually purchase it and they'll make us buy it back and keep it.
States with the highest rate of fraud risk are New York, New Jersey, Florida, D.C., and New Mexico. California, the priciest real estate market, ranked 9th. And fraud is easier than ever to perpetrate thanks to the internet. A quick search online will result in a bevy of sites that will not only generate fake pay stubs, but will actually answer phone calls to verify fake information.
Technology is definitely part of the problem because people can go and generate a fake pay stub and do all these things on the internet they couldn't do 10, 20, 30 years ago.
And the risk isn't just from borrowers. Brokers who package loans for lenders are also committing more fraud. Why? Because as interest rates rise and the refinance market dries up, they need more business from buyers. For Nightly Business Report, I'm Diana Olick in Washington.
While the housing market is starting to cool a bit across the country, a deeper chill is setting in on one of the nation's more expensive markets, New York City. And this is happening even as Wall Street pay rises, something that has historically helped lift Manhattan prices. Robert Frank explains.
It's a buyer's market in one of the toniest real estate markets in the country. Manhattan real estate now in a one-year-long correction. Total sales falling 11% in the third quarter. That's the fourth straight quarter of double-digit declines, according to a new report from Douglas Elliman and Miller Samuel. The average price of a New York City apartment is down 4% to just under $2 million. And the high end of the market saw prices fall 12%. As the rest of the country deals with a shortage of homes for sale, listings in Manhattan are now at the highest level since 2011. That oversupply is contributing to the decline in sales, along with fewer foreign buyers. Not even a rising stock market can lift sales, which are also hurting because of the recent tax changes in high-tax states like New York. Add to that rising mortgage rates, and even the entry level in Manhattan is hurting. Big price drops are now seen across the city. This penthouse in Soho is 5,500 square feet with 5 bedrooms, 4 bathrooms, and it's got 1,900 square feet of terraces with 3 fireplaces and an outdoor jacuzzi.
Right now, we do see some quite drastic price drops for properties that were overpriced to start with. I think if you're looking for something that was really overpriced, there are some bargains you can find throughout the city.
This first came on the market in 2016 at $25 million. It dropped this summer to $19 million, and just this week fell to $17 million. Whether that counts as a bargain remains to be seen. Bargains being a relative term in the dizzying heights of Manhattan real estate. For Nightly Business Report, I'm Robert Frank in Manhattan.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening, everybody. We'll see you tomorrow.